Hello to all. Just want to say, happy Thursday to everyone here who's joining our AQUMON, Seeking Opportunity and Protection in Current Markets. And I think for a lot of people, particularly in the past, I would say 2 weeks, I think it's been about a week and a half since we did our last webinar. Clearly, markets have been very volatile since then. And I think a lot of people do have a lot of questions in regards to what should they be doing in the current market conditions. So a few things I want to do is first go over a bit of a market outlook in terms of some of the ideas that we think make sense in this current market. So for those of you who know me, you know I love the red, green, and yellow light situation, just nice and direct, right? So I think in regards to the market outlook from maybe 2 weeks ago, I actually haven't made major changes, but I do have a few ideas I think we should be looking at. I list here, which is the positive, neutrals, and negatives. I don't think this has changed too much since 2 weeks ago. I think we're still running into the same issues in terms of one, policy support at this point is, I would say, waning at this point. But having said that, this week we already heard from out in Europe with the ECB that more policy support may be coming in down the road. But clearly at this point, the market is preparing for when we will actually be removing this type of stimulus. Furthermore, fund flows, I think this is for a lot of clients, a big headache right now, or even actually not even clients, fund managers as well, where to put your money. When we look at stocks, looks expensive. When we look at bonds, doesn't look like returns are that great. So I think for a lot of clients right now, it is a pretty big headache where to put their money. And obviously they could put it at the bank, but you get no interest rate there either. So that's obviously something that I think a lot of people are talking about. Furthermore, I think valuation is on the high end as well. Particularly now, it seems like the only game in town is everyone is buying US stocks in general, or maybe even US tech. But clearly when we look at the past week and a half, 2 weeks, even big tech has pulled back. So I think that's something that people should be really much more cautious about. But looking ahead, I think particularly local Hong Kong markets here, clearly earlier on, we had a lot of reforms out of mainland China, which is still being digested. I think at this point, for me, if you don't mind me saying a bit of a controversial call, for me, actually, I think this is time for a lot of customers to think about carefully accumulating here in Hong Kong, mainland China. I know we're not from the bottom, I get that. But I think this is something that people should be looking into because we've sold off quite a heavy amount. And truth be told, I think in this current market where people are flowing towards where they can find value, I think this is a time for people to start slowly and carefully accumulating, not go heavy in. I think that's quite important for people to think about. So let's do a little bit of a review in terms of how global markets have been doing recently. So I've done here a chart since year-to-date returns and also since early September, because pretty much markets since I think the first week of September have started, I would say, getting quite volatile and selling off. So there's a few things that jump out at me. The first thing is, I would say on the left is India has been a clear-cut winner for a lot of clients. I know for a lot of us, I've been investing in the financial markets now for about 18 plus years. And a lot of people have not had particularly great experiences with investing in Indian stocks. And it seems very far away. I mean, we're in Hong Kong. What do we know about India? But I think maybe just thinking about what I tell a lot of clients, thinking beyond Hong Kong makes a lot of sense. And for those of you who joined the webinar a few weeks ago, when I was talking about this or some of the earlier type blog articles that you've been reading from me since last year, this is something that really makes sense for clients, particularly very home bias clients. So even just taking the global approach, as we said in the middle, the MSCI World up about 12% year to date, and recently down about 3-4%. Yes, true. But then, on the far right, when we look at Hong Kong, particularly because Hong Kong markets have been very, I would say, very tied to Chinese tech stocks, the pullback has been very significant. But I highlight Chinese A shares as well, because I think for people who were very heavy set on mainland China early last year, which I would say myself as well, I would say that I saw value in that, but clearly could not see the reforms coming. But when I look at lately since September, I think relatively speaking, the market has clearly not digested all the information yet. And I think we're going to still see high volatility from now to the end of the year. But just seeing where funds are flowing out, I think for some investors to think about carefully accumulating in mainland China is something that makes sense, I think, for a lot of clients. I think just last week, BlackRock also increased their weighting from underweight to modestly overweight, also in the mainland market as well. So again, everybody very careful. So when I think about your pie, in terms of, like, let's just say you had 100%, clearly your investment into mainland China should be probably, I would say, 10% or less, right? We're not taking heavy bets on this by any means, but I feel that if you're looking for value in this market, that's something that you could also look at. Another one for me, even though the past month and a half has not been going so well, is Japan. I think Japan actually performed extremely well during early September, but has kind of sold off since, I would say, mid to late September. But this, to me, is a market that has quite a lot of value. Obviously, it's not a high growth market, but I think in this current investment environment, you've got a lot of clients right now looking for value or looking for cyclical plays, right? So this will be your banking, your financial, your financials, your industrials, your materials, your utilities, these kind of like lower valuation plays in this market right now. So everyone right now is looking for value. And early on, everybody understands is that the number one driver for support in financial markets has been monetary support. So how much money are they pumping into the market by the central banks? And I think at this point, clearly they are already starting to pull away the support. But I think for the time being, this is something that we can still rely on. So I still see growth in financial markets at this point. But for me, I think particularly for US markets, probably for the S&P 500, I would say maybe at this point, single digit growth in terms of this the S&P 500 index. But before the single digit growth by year end, I do anticipate volatility. So I think people should be concerned is in the short term, there may be market pullbacks that we should all be a little bit more concerned about. And furthermore, what we see this past, I would say 2 weeks or so, is a pullback within big tech, not just any tech, big tech in general. So your FANG, Facebook, Amazon, Google, Netflix, these type of names. And it's quite clear, I mean, I think for those of us who've been in the market, is that when we look at overall treasury yields, has a very inverse relationship with overall tech stocks. And the simple explanation is most of these companies you're investing in the future, right? And a lot of them require for every dollar they make, they reinvest it back into the company. And also they require a lot on cheap lending. And obviously as interest rates goes up, and obviously right now the inflationary environment is also going up, this is not as beneficial for investments that you're investing way out into the future, what we call long duration type plays. So this is something that I think for some clients, particularly in this environment, to trim a little bit of their big tech type positions is something that kind of makes sense in this environment, just because I think we maybe for a bit more, I would say, volatility ahead for big tech. But there are names within US technology that I think makes sense. Maybe looking at a lot more, I would say, semiconductor names or hardware type names will make a little bit more sense over the traditional names that we are all very familiar with. So this is something that I think we should probably be concerned about. Now, Netflix is an exception, obviously, after the recent Squid Games, done very, very well. Hope you all watched that. But I think the overall direction of the market, regardless of that, is not particularly in favor for these big tech names. So I think people should be much, much more conscious in terms of the technology names that they are picking. Furthermore, when I look at from a sector basis, right? So this year, the big winner by far has been energy. Part of that has been very much, I would say, commodities driven. I'll have a chart later to show. When we look at overall at, I think, oil commodities in general, like WTI oil, I think it's up close to 50% year to date. And then recently in the news, you hear a lot about natural gas as well. So again, winters are anticipated to get colder this year. Natural gas usage will go up. And I think it's very much a supply and demand game, but we'll talk a little bit more about that later on. So energy is something that I think for a lot of clients, they're asking, hey, by the way, it's run up so much, like, why should I even consider this? But I think when I look at the structural trend of where this sector is going, I think there's still quite a lot of upside on the commodity end, and for energy stocks as a whole also to be driven up by that. So even though it has been up a lot, I actually would consider a lot of clients should have a look at this sector. Furthermore, for those of you who've been listening for me for quite some time, I've been harping on financials, and I think it continues to deliver, right? So in this current environment where we see higher inflationary pressures, where we're kind of a little bit end of the cycle, we're looking at companies that are a little bit more cash rich, high fundamentals, and in this environment, it benefits a lot of financials. So a lot of US financials, whether it's your Goldman Sachs, JP Morgan, these type of names for me has actually done very well for my own personal portfolio. I'm also looking at Hong Kong, China names as well. But for the time being, I'm a little bit more focused on the US. So I think for a lot of clients that think about, hey, you keep hearing these big words in the market like reflation and stagflation, which is something that we actually talked about earlier. The difference, I think, between the two is just, particularly for stagflation, is in an environment where prices are going up in an inflationary environment, we actually see very little growth or a reduction in growth, right? So that's actually clearly not a good situation to be in. But whether the ending becomes a reflation play or a stagflation play, to me, the two biggest beneficiaries will be, one will be commodities or energy type names or direct commodities. Number two, I think overall stocks will still benefit, but in my mind, we should be looking at much more stocks that I would say are more cyclical plays or more, I would say, value type stocks in this environment. I think overall, as of last year until this year, clearly everything has been very momentum driven and growth driven. But I personally feel that value stocks will have their time in the sun shortly. So I think that's something that it just logically makes sense for a lot of clients because everything seems very expensive right now. But I think on the right-hand side, what we also see is the S&P 500. And clearly, I think at this point, it is one of the only markets beyond India and I believe Canada as well right now that has performed over 15% year to date. And again, for a lot of Hong Kong investors thinking about investing outside of Hong Kong, these are markets that we still see value in. And that's something that maybe you should also consider as well. So earlier I talked a little bit about energy stocks, and I wanted here just to show a graph that was talking about the actual different types of commodities. So natural gas, which is something that's jumped up a lot recently, up about 123%. And I think market analysts are still seeing further upside. WTI oil is up over 50%, almost close to 60% year to date. But even US energy stocks, I think even you're just buying an ETF that has US energy exposure, up about 43% year to date. But more importantly, particularly during the recent, I would say 2 weeks where we've seen a bit of a market sell-off, still up about 8%. And so I think for those of you who have or have not been following the markets, I think for me, there's clearly a supply and demand issue, particularly for a lot of commodity type direct commodities like natural gas, just because clearly at the end of the year likely will be much more colder than anticipated, particularly in a lot of our Western counterpart countries. But to me, there's also a further, I would say, larger structural play in here, which is clearly we're all moving towards much more green or clean tech technology. So actually the amount of money that's being focused on developing a lot of these fossil fuels have reduced significantly. So the amount of supply in the market actually has reduced significantly, I would say, over this past year as well. So this, to me, is not a story that's going to go away. And why, one of the reasons why I feel like when we're looking forward, I think a lot of these type of energy names will still see upside just because it's a basic supply and demand game. So I think for a lot of clients are thinking about, oh, by the way, I don't know which sector to look into. Clearly not asking everyone to go heavy into any sector, but I think this is something that clients should be looking into when they're looking for additional upside in this market. Furthermore, I think what's interesting as well is I put here is the Hong Kong stock, the Spider's Hong Kong stock index versus the Hang Seng Index. And what you see is actually a pretty big difference, almost a 10% difference. The difference between that basically is the Hang Seng Index has a, I would say, a much more heavier tech component, particularly China tech component, whereas the Hong Kong stocks I put here is pretty much purely stocks that were originated in Hong Kong, that are Chinese companies listed in Hong Kong. So I think that's something for a lot of clients right now. I personally, probably if I think about Hong Kong or China stocks right now, I probably would be leaning a little bit more to China stocks over the Hong Kong region, just because I think there's more unknowns locally than there are in mainland China. But having said that, I think if people are not so familiar with the mainland Chinese market and just want I would say, in for the ride, particularly with a lot of these Chinese tech names that I think from a medium to long term, I personally see it a bit more as a positive outlook, but short term, at least in the next, I would say, few months until the end of the year, maybe a little bit longer, I would say likely a lot of volatility in the market, mainly because one, there's no way to analyze the current situation. I mean, it's very much a human-driven or reform or government reform-driven decision. So it doesn't matter, even at AQUMON, we can analyze as much data as we want, but the data is fundamental data. And this is much more of a event-driven or human-driven data kind of outcome. So I think this is something that, for me, if I think about tactical bets, this would be something that I would consider a small bet in. But beyond that, I think it's one of those things that I feel like a lot of foreign investors don't quite understand what's going on in the local market, and they are pulling money out because they don't understand. But I think for many of us who are much more local investors, particularly myself, who has a bit more of a positive outlook, I think this is something that clients right now can think about, maybe doing small rotations into this area of the market, just because this is a part of the market right now that is actually quite cheap. And so if somehow the volatility lasts a little bit longer than anticipated, it's not going to kill you. But if somehow we see some uplift from this, it's going to look like a smart bet. So furthermore, I think a lot of clients ask about cryptocurrency. I think clearly that the space in mainland China has changed significantly, but here in Hong Kong, at least until I would say the middle of next year, we can still quite actively trade cryptocurrency. And I think for a lot of clients right now who are thinking about where else to see opportunity, I think for me, I think of it as a diversification in terms of an alternative asset that you can consider, and the numbers don't lie. Clearly high volatility, right? When we look at Bitcoin, the volatility versus the traditional Hang Seng Index, right? A Hong Kong stock market is almost like 4 times type volatility. So it's not for the faint of heart. But for clients that are thinking about, maybe I want to diversify a little bit more of my own personal investments into something that might be a little bit more medium to long term, that I might see sizable gains, I think this might not be a bad idea. I mean, I put here 3, Bitcoin, Ethereum, Solana, right? Obviously there's a lot, Cardano, there's a lot of different type cryptocurrencies out there, but even for Bitcoin, you're up 90% this year, right? I think since May, it dropped almost 40%. But, I think every time, although it's not a causation, but more of a correlation, every time it seems to hear a lot of ban type rhetoric, we see quite a lot of heavy rebound within the cryptocurrency space. But furthermore, when I look at ETH, Ethereum, I mean, it's not just clearly a play where you're just seeing this is I would say a medium store value, but I think there actually is quite high usage for this in the market, and that's why you see very heavy uplift with Solana as well, right? Recently with the NFT craze, obviously, for me, I mean, I think NFTs clearly extend way beyond the art space. So there still is a lot of high usage for this particular cryptocurrency. But I think, I mean, if you don't want me saying, for a lot of the NFTs in the market right now, maybe another year or two, I mean, a lot of that might not really be worth too much, but the underlying cryptocurrency may still see high usage. So I think maybe for some clients who are thinking about what to do in the current market, that's something to consider. So I actually, okay, so I wrote something wrong here, but don't worry. There's actually 4 takeaways for clients, not 3 takeaways. I added a bonus one for everyone. And for a lot of clients who are thinking about protection in this current market, the first thing I talk to a lot of clients about in this current market is increase your cash allocation. There's not going to be too many financial type people who are going to tell you to do this, because they're going to tell you about that cash is a horrible performer in terms of an asset class. And it is. I'm not going to deny that. But I think for a lot of our clients, it's about how well you sleep at night. And if you just feel that the current markets honestly have too much volatility for you to handle, take some money off the table. right? You can always come back tomorrow, next week, the next month. I mean, this is, again, the investing game is not something that's a one-week process. It is a lifetime process. So for some clients that are thinking about, how can I reduce my risk? My thing would just be increase your cash allocation, right? And to me, it makes a lot of sense in this current environment as well, not just necessarily to increase your cash allocation, but I want to have more bullets on the side, particularly if I see further pullback in the markets that I can actually slowly and carefully accumulate as well. Furthermore, I think investing 101, there is no free lunch in investing, but diversification right now, I think makes it quite a lot of sense. Like the earlier graph I showed, just purely from a regional perspective, taking a much more global approach to your own investments this year has paid off significantly from taking a very home biased approach. So I think for a lot of clients, diversifying both their regions and maybe even diversifying their like some of their thematic stock picks within their portfolio. If they're heavy tech, maybe what we can do is we can diversify the names a little bit more. That's something that we're doing with our portfolios here at AQUMON as well. It's not going to completely reduce the exposure, the market risk that you have to broad markets, but what it is going to do is likely going to, I would say, reduce the volatility and allow you to have a bit of a smoother ride, even if we see more volatility ahead. Third thing is actually thinking about alternative assets. So whether it's cryptocurrency, whether maybe, let's just say you might be looking at, like private equity in this current environment, or maybe even traditionally speaking, like gold, or maybe even like real estate. I think that might be something interesting for you to consider in this current environment, just to allocate a little bit of money away to that, so it's not so correlated to broad stock markets. Because for me, as people have been listening to me for quite some time, I think managing your risk is your number one concern in this market. It doesn't mean that I don't see upside. I still see upside, but to me, I want to be smart. And so what I'm doing right now is really making sure that my top priority is making sure that if markets do pull back, that I don't get hurt too bad, but I have exposure when if the markets do go up, that I actually am on for the ride as well. And then number 4, which I wrote as number 3 here, is doing some hedging. This is something that I think really many clients don't consider that they should consider. And it's not something that maybe a lot of clients are familiar with because it's actually quite difficult to do. But later on, one of the new products that we launch actually has these type of smart hedging type elements. And I think this is something that makes quite a lot of sense in this environment. So the takeaways, which have not changed from a week ago, but I still think makes a lot of sense. The number one, I think, is in this particular environment, looking at high fundamentals is something that every client should be doing. Last year, this did not make a lot of sense for a lot of clients because last year markets were very momentum driven. So if you were a fundamental driven investor, you probably didn't do too well last year. But this year, to me, this will really, really make sense, particularly in this current environment where right now it's about going towards more high quality type assets and, to me, more value type assets in this environment. So I think that's something that investors should really do and not just clearly just buy stocks on a whim. Number 2 is look for opportunities outside our local markets. And as I mentioned last 3 is hedging for downside risk. So I really have 3 takeaways for everyone. And obviously, if you have questions, you can really start asking them in the chat room. If not, what I'll do is I'll introduce a new product that we have on the shelf. It's been online, our SmartGlobal UltiMax product. For now about 3.5, 4 weeks. Obviously, markets are pretty rocky, but I would say it's been actually met with really, really positive responses by a lot of our clients. For those of you aware, AQUMON, we've launched a lot of portfolios in the past year, but it's been a while since we launched a brand new portfolio. I think the last one we launched was back in May. Seems like eons ago, but only a couple of months ago when we launched our SmartGlobal crypto portfolio, which was the one that had Bitcoin ETF exposure. But this will be a portfolio that I think is much more active for a lot of clients. And what we really like about it is most of the portfolios that we offer here at AQUMON are much more passive investing style. Yes, very fundamental driven, but much more passive. This one will be much more dynamic in nature. So about 40% of the portfolio right now will be dynamically seeking out opportunities in terms of selecting US stocks. Furthermore, we'll be looking at regional type opportunities, looking at regional ETFs. So we'll be investing outside of the Hong Kong market. Right now, it's much more heavy on, I would say, India, Japan, and I believe Canada. these three markets. And then furthermore, I think what's interesting about it is that it has a smart hedging element as well. So particularly when I think about the US markets where things could be a bit rocky, I think having these type of tools in your bag in terms of your portfolio is something that makes sense for a lot of clients. And the returns overall, this is the 3-year annualized return. So what I tell a lot of clients is, one is when I think about right now, this is only an offer to balanced to aggressive clients. So for more conservative clients, because the stock element is a bit high, we don't actually offer it to those clients. But for people who are thinking about medium to long-term type dynamic opportunities, what I see versus, I would say, a model portfolio, which is much more passive portfolio, is about a 3 to 7% improvement for clients over the long term per year. But actually at AQUMON, we're only charging an additional 0.2% per year. So for a lot of clients who actually feel like they can actually consider this portfolio, I actually highly recommend that for people just to even have a look. Just because we have a lot of sophisticated clients who come to us and the first thing they ask is, I don't want a long only portfolio, so it can only follow markets if markets go up. I am actually a bit concerned if markets do pull back, are you able to benefit from that? And this is exactly why we launched this portfolio as well. And earlier I mentioned, right now about close to 38%, almost 40% of the portfolio now is much more active in nature. They have 3 new investment strategies. One is called Smart Beta, so it invests in US stocks specifically. So we're no longer just buying ETFs, and this is based on AQUMON's own algorithm. Furthermore, we have Smart Rotation, which is a strategy that picks 3 different regional ETFs at a time that we think have momentum behind their wings to be able to actually, I would see, get excess returns in the short term. Furthermore, we also have Smart Hedging, which is a new strategy that particularly if markets look quite rocky, it will actually be increasing its hedging element to actually protect clients' portfolios and achieve excess return. So the Smart Beta strategy, what it does is thinks about in the entire US market, how can I choose actually stocks right now that are high quality in nature, and furthermore, actually thinking about which ones have additional momentum behind its swings. And then what I do behind the scenes is figure out, after I choose a portfolio of 50 to 70 stocks, what type of weighting should we apply to each individual stock. So right now, it has 3 legs. Basically, I would say a core element, which is 50%, I would say is US broad markets. But again, we're picking names in there, which we can show you later. We have an element that's 30% in tech and 20% in healthcare. The tech element, actually, I would say is much more of a medium to long-term play. But I wanna also be upfront with people that, this is something I think in the next week or so, we will also be making adjustments to this portfolio in terms of its sector ratings as well. Just because, in this current environment, I think we will also be looking at a little more cyclical names, just because we want to make sure we protect our clients' downside risk, particularly from a lot of the tech names. But the tech names right now in it are not so much the traditional names that you will see. I would say much more semiconductor names or hardware tech names as well. So these are some of the names within the core portfolio and also in the technology and healthcare element of it. Obviously, there will be names like Apple and Google in it, yes. But beyond that, I think there are a lot of, I would say, old school tech names like Dell. Furthermore, I would say like Intuit, which is much more of a financial fintech company offering a lot of cash and accounting tools. Shopify is also another one that maybe in Hong Kong that we're not super familiar with, but clearly the numbers and the growth of that company also looks quite interesting. The healthcare element, we also feel that right now, even though markets have been rocky lately, we do see quite good medium to long-term upside. So we are invested in, beyond a couple of big names, also I would say a couple of the Novo Nordisk, also out in Europe, and also Merck are a couple of names that we quite like in the portfolio. And a lot of clients, but behind the scenes, what we're doing is we're analyzing both, I would say, the size of the company. So we're not choosing companies that are super small, just because this is something that we want to control the volatility of the actual portfolios. We're looking at companies that are with high profitability and also high fundamentals. So we're doing a lot of work behind the scenes, but in front of the scenes, what you see is the stock picks. And for example, like Apple, I think we don't rank them like that, but I just make it quite simple for people is that when we look at the overall profitability, innovation type factors that we're assessing, it is ranked quite high. And why something like Apple will be ranked #1 in our portfolio, while something like NVIDIA, which is maybe not as big, but truth be told, I would say is also ranked very high, #10 in our portfolio right now, mainly because it's looking quite solid from a profitability and I think stability standpoint. And this is something that we hope can be much more of an anchor for our clients' portfolios. And when we look at the top 30 assets, I think I just want to list this out as well. The portfolio itself right now has about 70 to 90 different stocks in it. But I think the next version of it will be one, we won't only be looking at US stocks, we'll actually also be looking at Hong Kong stocks, and we'll also be improving this as we go forward. And furthermore, I think the actual portfolio itself right now, we will also be, I would say, trimming down the amount of stocks as well, because we do have a lot of number of clients who feedback that they felt the portfolio had too many assets in it. And this is something that we're also doing quite a lot of study into. And I could imagine going forward, we might be trimming down the number of assets as well, at least progressively. Returns kind of speak for themselves. I think currently in the market, I would say even with the smart hedging, I think we've seen quite a big sell-off in the we've seen a bit of a sell-off, I guess, in the past 2 weeks. But what we see, at least taking the SmartGlobal UltiMax, the smart beta element of it versus just taking buying the S&P 500, the performance is quite significant. We see average performance at least a 3% outperformance per year when we're looking at the past 15, 20 years. So I think this is actually a pretty sizable outperformance. And a lot of people are very interested in the smart rotation. Smart rotation is thinking about how can we select actual regions outside of the Hong Kong market, or potentially including the Hong Kong market, that we quite like, that we feel that there's potential upside. Right now, we are more heavy in the US, India, and Japan region, but I think this rotates as well over time. So I can show you that beyond the 12 markets that we look at, these were some of the early picks that we had in the year. I apologize that the graph is not the best, but what I can say is I think within the year, you can see it's almost every 2 weeks or so on average. Sometimes it might be days, sometimes it might be a month, but on average, every 2 weeks, we're actually making adjustments in it in terms of the different regional markets that I picked. So the regional market is by the black filled in box in terms of which regions that we like. And some of the positive and negative calls that we've made in 2021, I quite like is one, I think, is UK stocks that we made a call back in March, up 7% during a pretty short period. India's up quite significantly. I think it's actually up over 6% right now. I apologize, but from August 17th till now, I think it's up close to, I would say, about 8% or so. And then also Swiss stocks, which we called earlier in the year as well, I think was not a bad call. Some of the negative calls that we've made, I just want to be upfront and honest as well, was in mainland China and in Hong Kong. And part of it is because the way we analyze the stocks, particularly from a factor and fundamental basis, is it's actually quite hard to analyze for reform or human type changes. But having said that, what I can say is that, so for example, for these, for China stocks, we bought in on May 3rd. And then it was President Xi was back in, I believe, July 21st or July 27th when he made the announcement about the reform, started making a lot more aggressive reforms in the market. We were actually up about 5% at that point. The actual call itself dropped, I think, to about -5%. And we ended up selling when we were down 1.8%. So again, there is some element, I feel like, even though there are reform type impacts, I think the overall, if you look left versus right, the benefits that we're getting on the left far exceed, I would say, the losses that we see on the right. And the returns, we think, for the overall strategy can actually has been quite positive. It's only 3% of the portfolio right now, mainly because I think at this point, we're still relying a little bit more heavily on our stock picking versus our regional ETF picking. But this is something that I think we will also be expanding going forward as well. So what we feel is with a lot of the smart rotation, it provides two great benefits for clients. One is it allows clients to further diversify outside of their home market. And I think there are quite a lot of opportunities there. But furthermore, I think a bit more tactical active picking is something that makes a lot of sense for clients in the current environment as well. And last but not least, smart hedging. This is something that I think a lot of clients ask about. One thing I think a lot of clients can agree right now is that when we look at US markets, valuations are relatively on the high side. And I think a lot of clients are wondering, is this the end? I personally can go out and say that I clearly don't think this is the end. I still think this is upside, but having said that, I think there is a pretty decent chance that we might see a bit of a pullback before we see the next up. So I think clients should be a bit more careful about this. And furthermore, a VIX this year, actually, I would say the past year and a half has been elevated as well, but particularly recently, I think, when we look at the fear index in the US, the VIX has actually been quite a bit more elevated. And actually, when you see, when I talk a little bit more about our smart hedging, actually our smart hedging has been going in and out. What it does essentially is that when markets are stable, so this is what when markets are stable, it will go out and buy the US broad market index, so the SPY. So this is like an ETF that's based on US markets. And when markets are quote unquote not stable, it will be buying a hedging ETF, which is hedging ETM, which is the VXX. So the way we look at it is, for most people that try to do hedging, it actually involves you actually thinking about buying and selling a lot of futures on, let's just say, if you are focused on the US market. But this is actually quite tough for many individual investors, mainly I would say due to two main reasons. The first reason is because it requires active management. And truth be told, most of us is, we're busy people. We might not have the skill set to do this. And even for, I would say, seasoned managers, this requires quite a bit of work. And two is actually to buy hedging is something that you shouldn't just buy and then hold on to it, because hedging has actually added costs. So if you buy in at the wrong time, or you, let's just say, are always holding on to hedging or some form of a hedge, then what it's going to do is just eat into your returns. So what we actually look at is we look at the futures for the VIX from now until all the way out into the investment horizon. And what we look at is the shape of it, right? So overall, what we talk about is in a normal situation. I can show you, it looks a little bit more like this on the left, right? So this is what we call contango, right? So again, things that are further out in the future cost more. Makes sense, right? Because clearly it's more unknowns that could happen. That's why it should cost more. Things that happen in the recent times should cost less, because you can kind of anticipate what may happen, or the chances for things completely changing is a bit less, right? But in certain situations, you might actually see this flip-flop, and this is a situation what we should call backwardation, right? So again, it requires some form of analysis, but most people actually don't really look at it actively. And obviously at AQUMON, with our algorithm approach, we can do and actually look at this very accurately. And what we do is, when we see that actually the overall VIX futures are already moving in that direction, the backwardation type direction, then we'll go out and we'll actually go by hedging. Actually, so since we launched a portfolio on September 3rd, we've already made 3 moves. Early on I believe September 18th, we already bought a little bit of hedging. We sold out of it on about September 20th. And then recently on September 25th, I believe, we bought some new hedging as well. So again, we're also a bit cautious of markets right now. So that's why the portfolio right now, actually the hedging element is activated as well, but there will be times when it isn't. So this is showing a lot of clients. The blue shows when the hedging element is active, and the red is showing the VIX in the market. So what you can see quite clearly is that we actually have had a number of times where we're able to activate the hedging right before markets were actually very highly volatile. So I think for a lot of clients that are thinking about, hey, I don't just want a passive long only portfolio, I want some of this smart hedging element, this will actually make sense for quite a number of clients. And also furthermore, I think beyond protection, we think a lot of clients can consider this because we feel that it can offer about 2 to 4% additional return for clients, because this actual hedging element isn't just about hedging. It actually, when it actually feels that markets are much more stable, it's actually long the US market as well. So the mixture of the two, we feel on an annualized basis, can provide clients with another 2 to 4% returns. So again, think about clients when they the title of this webinar is where can I find protection and also opportunities. This is something that actually makes sense for quite a lot of clients, thinking about where can I seek opportunity in this current environment, but if markets take a turn for the worse, where can I get some added protection as well? Okay, so the portfolio itself, I just want to keep it simple, is a premium portfolio in our shelf right now. All AQUMON's portfolios on our AQUMON app right now start at 10,000 Hong Kong dollars. This will start at 13,000 US dollars, so about 100,000 Hong Kong dollars. And the main reason behind that is because the number of stocks and assets I invest into are actually quite a lot. But the overall fee for this is only, I would say, 0.2% higher than our normal AQUMON portfolios. So for clients that are asking, there's a few things. Existing clients who may have bought into our SmartGlobal Max portfolio, which is our flagship ETF portfolio, that asked me, hey, Ken, should I be switching into this? I think for these clients where it's more an apples to apples, this is almost like an upgrade for that portfolio. So I think for some clients that want to switch in, this could be something that they can consider. For people that bought into, let's say, our SmartGlobal portfolio, which is a Hong Kong ETF portfolio, this is a bit different, right? Because that has much more Hong Kong, China, and also tech exposure. So it's not really a one-for-one comparison where you're just switching into this portfolio. But for some clients that are thinking about in this current environment, can I actually switch into a portfolio that makes, I would say, a more dynamic sense in this market? This is something that we think a lot of clients should consider in this current environment. And actually, by the sales numbers that we've seen in the past 3.5 weeks, I think has been actually quite strong. I think a lot of clients right now has been seeking some, I would say, premium type offerings to help them both seek upside, but also protect against the downside in this market. All right, so I'm not going to take up too much of everyone's time. It's about 1:14, so I've spoken for a little over 40 minutes. So what I want to do is kind of open up the floor for questions. And if you have any investing related questions, AQUMON related questions, maybe even other type questions as well, I'd be very, very happy to answer that, and very happy to answer that as honestly as possible. So it's not been an easy time in markets the past 2 weeks for all investors. But what I hope to do is that we always have high transparency here at AQUMON, and we also will always lend a helping hand to all our investors and also all our, I would say, new friends as well who may be joining this webinar. All right, seems people are a little bit on the shy side. Okay, yeah, no problem. Yeah, I think what we'll do is we'll open up the floor for questions. We'll wait a few more minutes. If somehow there are no more questions, I'm okay with that. I think what I wanted to do was, if you don't mind me asking, for those of you who are in the chat room right now, if you mind me asking, what are you guys most concerned about in markets right now or with your own investment portfolios? If you could write that in the chat, that'll be great. It might be a great conversation breaker. Okay, all right, so, okay. So Tanny is asking is, apart from the advisory fee, what are the other costs? So at AQUMON, beyond the advisory fee, there are also transaction fees, third-party transaction fees that AQUMON is not charging, but over, I would say, at the US Stock Exchange or at the Hong Kong Stock Exchange. But truth be told, I think whether it's for our normal portfolios or for this new premium portfolio, generally speaking, depending on how much the client is investing, the third-party fees, I would say, would be, it depends how often the client transacts, but maybe I would say another 0.2, 0.3% for clients if they're based on, I would say, the rebalancing rate of our normal portfolios. So like, for example, our more passive portfolios, they rebalance once every, I would say, every 3 months or 4 months. So it only rebalances about 3 times a year. But this portfolio, what we've seen with the SmartGlobal UltiMax is that it has rebalanced just in September because markets were quite volatile. I think it has made 5 little adjustments already. But the overall actual contribution in terms of additional cost to clients will be relatively low. So I think it will still be around 1% for a lot of clients because, one, you're investing a more sizable amount at $100,000, and 2, more of these are micro adjustments. Okay, so Pani asks, how do you assess the current and future economic risk? It depends. I don't know if you could clarify that a bit more. For me, I look at data and also I would say the macro outlook. So obviously from a macro outlook perspective, I've been in the market now for 18 plus years, right? So to me, the things that ring off the top of my head is one, we're entering much more of a late cycle in the economic cycles. So clearly, I don't think the prior 11 plus year bull run is something that's here to stay. So clients, what they should be doing right now is thinking about looking forward. My returns will definitely not be as high as they are in the past. If I told you they're just as high, I'd be lying to you when I wouldn't, right? But furthermore, I think we are in a bit of a tricky situation right now where it's almost like our markets are pumped full of steroids from a lot of the central bank money or the liquidity that's been supporting our markets. And it's a bit of a tricky situation where when they obviously now taper away and remove that type of support, whether the markets will have what we call a soft landing. So again, if it's just, I would say, even if it pulls back, it's rather small, or whether it will be actually something that will be much more abrupt. And I think that's something that a lot of central bankers probably need to be very careful about. Okay, so furthermore, you mentioned about inflation and the Evergrande situation. So my outlook on the Evergrande situation has not changed from 2 weeks ago. I tell a lot of clients that I have two takeaways for them. The first takeaway, which turned out, I guess I got a little bit lucky, turned out to be true, is clearly there's not only one Evergrande, right? When you find a rat, there usually is much more. There's a lot more rats that are with that rat as well. So I think I think for one, if I think about it, in the mainland, there will be a sentiment type issue where we see much more these type of companies being exposed, maybe not only in the property market. Now, do I think this will affect the overall global financial markets? I don't think it's going to be that to an extent, but definitely in the mainland, probably in Hong Kong, sentiment is not going to be as positive because we're essentially going to uncover more and more of these type of Evergrande type, I would say, not good fundamental companies, maybe to be nice. And then in the current inflation environment, I think this is something that people now are so heavy on big tech to tell them to wean off big tech and move into more names, cyclical names, whether it's financials, materials, industrials, utility type names in this current environment, energy type names in this market is not easy for a lot of clients. And I think that will be something that a lot of clients will need to slowly kind of learn. So I think for your two questions, one is I think local markets will continue to be rocky, both from further Evergrande type situations. And I think it's on a bit of a witch hunt right now, but my outlook is actually positive after we get past this. But inflation wise, I think this is something that you hear a lot in the news, you don't know what to do. But what I'm letting you know right now is in this environment, focusing a little bit more on value and cyclical names would make a lot of sense for clients. Yan Yi said, how will the increased interest rate, which we're all expecting, affect your strategy in managing AQUMON's portfolio? So a few things that I think will affect us. I don't think it will be a direct, I would say like a very direct increase, but I think in terms of how we select, what types of stocks that we select, I think that will definitely affect that. Just because traditionally speaking, in an inflationary environment, you don't want to invest in, I would say, names that where you're investing in the future, what we call long duration plays. So I think this is something that we'll probably be doing, is probably trimming down some of our tech exposure as well. But furthermore, I think for a lot of the blue chip type names, we'll probably be looking at some of the more value old economy names as well, that I think right now has not been receiving much love. But we think that actually through analyzing the data in the market, that we think we can find additional upside for clients. But I think for a lot of our portfolios, they are not directly tied to interest rate movements. But truth be told, when you look at globally speaking, this is the world that we're in. And I think for a couple of the takeaways that I mentioned to clients right now, look for high fundamental companies, look outside our local markets, and maybe look for some alternative investments is something that really makes sense in this current environment.
Hey Ken, hi. It's Corey here. Can you hear?
So we have or maybe if other people have additional questions, please do write it in the chat room, and we'll give everybody a few more minutes, right?
Hey Ken.
Yep, seems like Corey, you want to speak, but we actually muted everyone. So if you don't mind typing your question, Corey, that would be great.
Okay, sure. Yeah.
Yeah, it just because there's a lot of ambient noise, so I'm just quite aware of if we unmute people that it might be a bit hard to ask the question. So if you type the question in the chat room, Corey, I'm sure we'll be able to answer that. Yeah, and while maybe Corey's typing this question, or while we have other people thinking about questions in the market right now, I just want to say thank you to everyone. Just because you know, we've actually seen very sizable growth at AQUMON, I would say the past 2 years, but pretty much since we launched the app. I would say since the past 2 years under COVID, which was, in my mind, actually a bit of a black swan event, but turned out to be a blessing in disguise. We've really seen about 4 to 5x growth in terms of new users for our app every single year. And it's actually been quite a surprise, I would say, you know, coming from a very traditional background. I did not think that, you know, early on, particularly adoption in Hong Kong, you know, people are a bit more conservative, but what we're seeing is more and more people utilizing our app and actually benefiting from it as well, just because a lot of the earlier hypotheses that we tried to do was think about maybe a lot of people that worked in the financial industry, like myself, you know, or maybe have already heard of robo-advisors. It makes sense to actually invest in these type of solutions. But then actually now what we see is more and more non-financial people who are just actually are not unsure how to invest in the market, are looking for a smart tool. And furthermore, is just think about how can I save time and save money. So I think a lot more of our clients now are much more like lawyers from legal industry or like IT, education industry, medical industry. And we see a lot more of these type of people, and also a lot of students. I'm doing a webinar tonight, and we already have 250 plus students signed up already. So again, a lot of support from both, I would say, a lot of white collar individuals and also a lot from students. So Corey, so thank you for your question. You said, is there an option to auto monthly payment for SmartGlobal UltiMax? And there is not yet, but this is something that will happen, I think, probably early next year. I think for the time being, we do not have a auto top-up feature. So clients actually need to top up themselves. But if Corey, you are interested in this, what I can do is I can take it offline and we can set a reminder for you as well. But we don't currently actually have an auto feature, top-up feature. And then Corey also mentioned is, what is your recommendation allocation of the money between smart stock versus smart global portfolios? Okay, that's a fair question, right? So actually, when you look at the smart global UltiMax portfolio, to me, that is very in line with my own personal thinking, which is core satellite approach, right? So you want to anchor to your portfolio. So what I usually would do is for our smart global portfolios, for that to probably be about 50% or maybe a bit more, particularly in this current environment, I would say probably a bit more. But the smart stock wise, it depends which portfolio you choose, right? Because right now, obviously, if you were to choose, let's say, US tech or Hong Kong, China tech or healthcare or high dividends or property, like I think that would make a difference. But if you don't mind me taking just a step back, if you had $10, right? So what I usually would tell clients at this point is at $10, the allocation wise, I would not tell you to allocate all $10, right? I probably only tell you to allocate 7 at most, right? And to leave $3 aside as cash, or you can put it in our cash management product for the time being. So at least you're not getting 0 interest. But I think this will benefit a lot of clients, both in terms of riding out the volatility right now and also having a few more bullets in case markets do pull back a little bit ahead. But I would say right now for me, if you only have, I would say $7 out of the 10, I would say probably like a $5 in a smart global type portfolio, and then maybe $2 in a smart stock type portfolio. That's how I would think right now. But it depends what type of smart stock portfolio you're interested in. And if you just buy, let's say the UltiMax portfolio, then it already has kind of a similar breakdown, except maybe not so much in cash. Okay, so I'm aware of the time. We were supposed to be until 1:30 today, and it's 1:27 right now. So maybe we can pause just for another minute or two in terms of questions. If there are questions, great. If not, then I really just want to thank everyone for joining today's webinar. We'll actually have a Cantonese webinar on Tuesday. Obviously, we'll be talking markets a little bit differently then, mainly because markets are moving so quickly. And obviously, if you can understand Cantonese, that might not be a bad webinar to join. But we'll also be introducing the SmartGlobal UltiMax to more clients as well, just because we've seen such great response from clients, and we just want more people to learn about it and know about this portfolio as well that's on our shelf. And so, if there aren't additional questions, maybe we'll call it on for today. And I want to say happy investing to everyone listening, and we hope to see you guys soon. So thank you very much for supporting us at AQUMON, and have a great day.